hello to everyone who's on the line with us today. Thank you for joining this session. We will get going very shortly. We're just going to give people a few minutes to dial in and join us. In the meantime, it would be fantastic to know where you're all joining us from. So if you could use the chat function button and just let us know where you're dialing in from, that would be great. We tend to get a lot of our audience from Asia Pacific, and the Australian capital cities as well. So yeah, welcome. We'll get going shortly. Please do use the chat function and let us know where you are dialing in from today. Hong Kong, wonderful. Hello, one of my favorite cities. Nice to have you here. Dubai, wonderful. Another from Hong Kong, brilliant. Hello. Got very much an international audience here, Lars.
Sounds excellent.
Oh yeah, Malaysia, India, Hobart. Hello to a fellow Australian. Wonderful. Singapore, hello. Indonesia, wow, I don't think we've got, apart from 2 Hong Kongs, I think everyone's from different countries. That's brilliant.
Sounds like we got all of Asia covered. We're just missing East Timor and Brunei, it sounds like.
Yeah, we're almost there. Maybe a few from Thailand and we'll be fully covered in the Asia. Wonderful. Well, we will get going with the webinar. So thank you so much for everyone for joining us on the line today. And welcome to this webinar on pandemic ripples and changing business models in liner shipping. My name is Holly Baldwin. I'm here from Informa Corporate Learning. Just to let you know, this webinar will probably go for about 20 minutes in terms of content, and then we will do a Q&A session at the end. So please, 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 as we're going along, use either the Q&A button or the chat function, type in your questions, and we'll answer as many as we possibly can at the end. But in the meantime, welcome, Lars.
Thank you so much. And let me jump straight into it. The overall topic here are on the pandemic ripples and how that's going to change some of the business models in liner shipping. And that means in terms of agenda, we need to spend a little time on understanding what these ripples actually are that came through here in 2020 and 2021, where we are now, and then what's going to happen both in what I will call the short term and also in the medium to long term. I'll try to be as brief as possible. The problem is there's a large amount of events that has happened here over the last 18 to 20 months. And basically, this is a pretty apt description of the state of the market today. It's not one thing, it's not 2 things, it's many different things that have all gone wrong at the same time. Not because anybody did anything wrong, but because all the actions that were taken tends to trip each other up. And that's basically the nature of the ripples. So let's try to take a relatively quick look through the main elements of these ripples. Element number 1, that is back in 2020. And this really set the whole stage for where we are now. What you're looking at here is a very simple measure of the number of canceled ad hoc sailings, in this case, purely on Trans-Pacific and Asia-Europe. But it illustrates pretty well the first stages that impacted the industry. Stage number 1, those are the red bars. That is cancellations in the wake of Chinese New Year 2020. Normally, after Chinese New Year, there already is a lot of blank sailings. That's seasonality. That's the light red bars. The dark red ones, those are the added cancellations that were due to the pandemic hitting China. Fine, then we have a small, tiny, brief window where China was reopened. And you can see a drastic decline in the number of blank sailings. We basically never see 0 blank sailings. There's always a few ones there. So this is effectively coming down to a normal state of the market for just a couple of weeks. Then the rest of the world shuts down. So demand once more drops off a cliff. And now you've got a more broad-based peak, especially during April and May, with a large range of blank sailings on the major deep sea trades. This sets in motion a number of different elements. First of all, the brief dip here around week 12, week 13. This is where you see a large amount of vessels leave China chock-a-block full with cargo. But before they ever arrive at destination in Europe and North America shuts down. So a lot of this cargo has nowhere to go, ends up in the wrong ports, or ends up getting stuck in the terminals because the importers either cannot pick up because of lockdown or don't want to pick up because they got nowhere to sell their goods. This already begins to create congestion problems in the terminals. Then we have another ripple effect that turns out to be important, and that's in terms of the equipment. Think about it this way. By the end of March, this is when demand slows down. So the first week of April, that's where we first see a strong pickup in blank sailings from Asia. And let's look at this first from a European perspective. If I blank a sailing first week of April, that means first week of May, this vessel does not arrive in Europe, which is fairly logical since it didn't leave. But if it doesn't arrive the first week of May, then the second week of May, the same vessel is not there to load all the empties that needs to go back to Asia, which means by the last week of June, this vessel is now not arriving in Asia with empty containers because it never left. So in the first week of July, we are not having empties delivered into the depot. This is when the issue started. The issue peaked only about a month later. So in the first week of August, this is where we see a massive impact in terms of empties not replenishing the depots in China. And here comes the kicker, because in early June, the US consumer is bored sitting at home, so they start buying lots of stuff online, a lot more than they usually do. And in order to service that market, that of course requires a lot of cargo to be put into containers in Asia and China in particular. So this huge drawdown of empty containers in Asia now happens at the same time where we are not getting empties replenished because of decisions that were taken months earlier. This is one of the most important early ripple effects that we see. So running short of empty containers in Asia is not because anyone did anything wrong. Everybody made the right decision at the point in time where you saw a demand decline, but it had ripple effects lasting months into the future, setting the stage for a major problem in terms of empties. Another problem we saw was we had a fairly rapid catch up in terms of volumes in the second half of 2020. What we're looking at here, look at the right-hand side, the blue line is from 2019 and shows across the 12 months of the year how big a share of the cargo is usually moved in each of the months. And you can, of course, clearly see the seasonality in February after Chinese New Year. The orange line is what happened in 2020. We had a huge shortfall of demand in April and May, and then basically Q4 was catch-up. When we look at 2020 in its totality, we shipped almost as many containers globally in 2020 as we did in 19. The problem was we shifted that demand from Q2 into Q4. And whilst you can, of course, argue it's the same amount of containers, we can't magically conjure up more ships or more terminal capacity or more containers in Q4 because we can't inventory what we had back in Q2. And this sets the stage for congestion to become even worse. I'm going to talk a lot about Los Angeles, Long Beach, but it's not because that's the only place the problem is. I'm going to show you later on. This is genuinely global. It's just a lot easier to have a tangible, very simple example. And what we saw happen here in Los Angeles, Long Beach was the problem escalated during Q4. This is where we had this demand boom specifically coming into North America, this shift from Q2 into Q4. So you had an extreme amount of ships arriving at the same time. And adding insult to injury, this was also the time where hundreds of port workers tested positive with COVID at the same time. So you have an armada of ships coming in and you got low productivity in the terminals because of COVID. That means you got a huge pileup of ships. In the beginning of 2021, you're getting to the point where you have about 35 ships waiting outside Los Angeles, Long Beach for a bit over a week. This is only 10 months ago. And at that point in time, this was seen as an unmitigated disaster. This was an extreme lineup of vessels and a week delay was almost intolerable. Let's say since then, we became wiser in terms of what a disaster is, because this was clearly not the peak of the problems. Then in rapid succession, a number of additional things happened. After a few weeks of gradual improvement after Chinese New Year, this happens. Suez gets blocked, which throws another spanner in the works. When Suez finally reopens, this means all the vessels are released at the same time, all the cargo coming into Mediterranean and North Europe at the same time, completely overwhelming the ports when all the cargo arrives at the same time. But you have another ripple equally important. Another ripple you see here is this, of course, also now severely delays all the vessels that were supposed to go to Asia with empty containers. So the progression we had in trying to rectify the shortage of empty containers in Asia was suddenly also thrown off course because of the Suez Canal, which of course has ripple effects over onto the Trans-Pacific, to Asia, Australia, to Asia, South America, and all the other trades. As if this wasn't enough, the next ripple, the shutdown of Chinese ports, first one being Yantian. And if we look at Yantian alone, this had a larger impact and more ripples than the Suez Canal. The Suez Canal just gets a lot more press because it is so visible to see a big ship blocking a canal. But in terms of the cargo flow that is impacted, the duration of this, the number of vessels, Yantian was a lot more important than Suez in terms of making ripple effects and destroying the supply chain. When Yantian finally reopened, we had a shutdown of one of the terminals in Ningbo on top of that. So from a beginning of 2021, where we thought we had major problems, this only got progressively worse until the point we're at now. Looking at a few additional aspects. One thing is, let's go back and look at demand. One thing that's important to note here, which might sound odd, is that we actually don't have a global demand boom. Of all the many problems we have in the supply chain, this is not one of them. The usual way we always measure demand in container shipping is year on year, because that takes out the seasonality part. That's the blue line. If we look at this, it does look like a demand boom. We got 15 to 20% growth first half of 2021. But that is a complete misrepresentation of the actual state of the market. The only reason why we have such high growth rates in first half is because we're comparing to the bottom of the pandemic impact in 2020. This is not a measure of market strength. It's a measure of how deep the hole in the ground was in 2020. A much more reasonable way of measuring market growth is to compare 2021 with 2019 and then say, fine, what's the average annual growth seen over that period? That's the red line. Structurally, the global demand growth has been around 2 to 3% fairly consistently since summer 2020. So from a global perspective, there is no global demand boom. There has not been a global demand boom. We have very, very normal growth. That begs the question, if we have such benign and normal demand growth, if we had enough capacity in 2019, why do we clearly have capacity shortages right now? There's a couple of explanations. One of them is we might not have a global demand boom, but we clearly do have a boom into North America. One way of looking at that is this way. On the x-axis, that's the total share North America holds of the total import volumes around the world. So they account for roughly 19% of all imports in the world. But on the other axis, I've also shown how much of the global growth does North America account for. They account for at least half of all the global growth. So whilst we do not have a boom globally, we certainly have a boom in North America. That is one of the key reasons for the congestion problems to happen. Because if I have a boom in one trade and not the others, the easiest thing in the world to do is to redirect the ships, move them from low growth trades to high growth trades. I can redirect equipment. That's also not a problem. I cannot redirect a port. I cannot redirect truck. I cannot redirect the rail. This ramps up congestion problems, in this case, especially in North America. Congestion problems means that ships are sitting idle for weeks outside ports. That effectively removes capacity from the market. A ship that sits idle for 2 weeks, that's basically 2 weeks where it cannot move cargo. So it's fairly straightforward to look at delays of the vessels and then simply calculate how much effective capacity has been removed from the market. And this is what you get over the last 10 years. In the decade leading up to the pandemic, there were also delays. I mean, that's inevitable in our industry. And the normal baseline is roughly 2% of global capacity is always unavailable because of queues somewhere. But this escalates dramatically as we get to the very end of 2020. And then it peaks in January at around 11% of global capacity being removed. It improves slightly going into the early parts of 2021, but then we have Suez, then we have Yantian, then we have Ningbo. And we are now at a point with the latest numbers that just came in just before the weekend, those covered September, we are still at a point where 12% of the global fleet is unavailable because of delays. To put that into context, this would be the same as if we were in a normal market condition and suddenly COSCO or CMA CGM decided to burn all their ships overnight and make them unavailable to the market. That's the level of impact we have right now. This is why we do not have enough capacity in the world. And let me qualify that. We have enough ships. There are plenty of ships in the world. The number of ships is not the problem. The problem is the amount of time they spent sitting in queues. That is why we don't have enough carrying capacity. With demand now exceeding capacity, and we cannot increase capacity anymore, there's only one thing that can then happen. That's prices will go up. And that's exactly what we see. These are spot rates from World Container Index, but honestly, it doesn't matter which rate index we look at. All of them show exactly the same thing, rapid escalation in prices. And this is basic market dynamics 101. If demand exceeds supply, then prices will continue to go up until sufficient amount of demand is priced out of the market. If you're following the market, you will also know that over the past few weeks, there has been either a plateauing or a slight decline in some of the freight rates. But as you can see here, any notion that we are on the path to normality, we can forget about that. Even in trades where you have certainly seen some degree of a pullback over the last few weeks, those reductions are minute compared to the extremely high levels we're at. And before we jump to conclusions and think now the market is going to normalize, look at the graph in the middle for the Asia North Europe, for example. Here you also see a slight improvement in the wake of Chinese New Year. And that's only 8 months ago. And that prompted people at that time to believe now surely it cannot get any worse. And now things are improving. So before we jump to conclusions over the slight rate declines over the last few weeks, we need to keep that one in mind. There's absolutely no guarantee we have seen the worst. Chances are it's actually going to be worse in the next few months. I'll get back to that in a second as well. But not only does the rate levels increase sharply, perhaps more importantly, the spread in rates becomes extreme. In this case, I'm using Sinita data to look at the difference between spot rates and contract rates. In this case, spot rates at the higher end of the market, contract rates for some of the larger shippers in the market. Before the pandemic, the normality was a spread of about $400 per FFE between the guys that ship on spot and the larger BCOs. Now, the rate spread is more than $10,000 per FFE. This has a profound impact on the shippers themselves. This severely skews the competitive environment. And there are two dimensions to that. This means that very large BCOs now have a substantial competitive advantage over their smaller competitors. From a large importer moving on contract, I now have $10,000 advantage over my small competitor that moves on spot. Same thing if I'm moving goods that are high value and low volume. These freight rate increases does not destroy my business. It's an annoyance, but that's about it. If I move cargo, like for example, large appliances or large amounts of furniture, this is a major problem because my cargo is very bulky and does not have a very high value compared to how much goods I can have inside a container. This has a significant impact on the competitive environment of the shippers. And as I was already alluding to, it does not appear this is going to get better anytime soon. Again, if we look at the US West Coast first, I was making a count yesterday. We have 74 vessels waiting off the coast. As I mentioned early on, when we were in January of this year, everybody was up in arms over a queue of 35 vessels waiting for a week, and that was an unmitigated disaster. Now we have twice that amount of ships, and they wait more than 10 days when they're out there. So I don't even know what words to ascribe to this. There was a hope that this was getting better after Golden Week in China. In the first few weeks of October, there was actually an improving trend that has been fully reversed. So we had around 70 ships when it peaked in September. This went down to roughly 55 vessels in the beginning of October. A week and a half ago, it was back up to 79. Now it's 74. There are no signs at all that this is getting better. If we look forward to the near-term future, there are two major risk elements. China is the largest risk element. Keep in mind the impact from the closures both of Yantian and of Ningbo. In both cases, that was because you had just a few port workers who got tested positive with COVID. The Chinese strategy to COVID is very simple. They will shut down regions to prevent the spread. You have regions right now that are shut down. Fortunately, none of those include major ports. It's not many months ago, you had air freight operations halted in the airport in Shanghai because a couple of ground handlers got COVID. So realistically, we are only 1 or 2 sick port workers away from Shanghai shutting down, or Qingdao shutting down, or Tianjin shutting down, or potentially Yantian shutting down again. We can hope that doesn't happen. That would be great if it doesn't happen, but it is very much within the realm of the possible that we could see further shutdowns over the coming months, further worsening the existing situation. The second major risk element is the contract between the Port Workers Union and the terminals on the US West Coast. The contract for the laborers there expire by the end of June 2022. So they need a new contract negotiated before then. If we look at how this usually goes, if you look over the past couple of decades, this is usually relatively binary. Either they end up with an agreement and there is no disruption. Of course, a lot of noise before that happens, but basically they get an agreement and there is no impact. That would be great. But there are also cases where there was not an agreement. There are 2 cases in particular over the last just 20 years. 2015, there was not an immediate agreement. This led to a slowdown. And by the beginning of 2015, the bottlenecks and the queues off the US West Coast were as bad as they are now. So if that happens, we can imagine what that would do to the current situation. 2002, there was also a failure to reach an agreement. And that led to a situation in late summer 2002, where all ports on the US West Coast were completely shut for 10 days. So the spectrum for spring and early summer 2022 is, at best, there will be no impact. They will get an agreement. At worst, we will see a drastic worsening of an already poor situation. One thing to also keep in mind is it is easy to look at an image like this. This is from Vessel Finder. Every yellow dot is a vessel that's waiting to get to port, and jump to the conclusion that the port is inefficient. But that would again be a misinterpretation. The problem to a large degree are not the ports and terminals. The problem lies inland. There are terminals right now in Los Angeles and Long Beach that have idle equipment. There are terminals in Los Angeles, Long Beach that have port workers they are not calling into work because there would be no point. The problem is not the terminal's ability to handle the vessels. The problem is the importers are not picking up the cargo. If the importers are not picking up the cargo from the terminal has no space into which to offload more cargo from the ships. So in order to solve the congestion problems in the terminals, we need the importers to pick up cargo. If you look at data for US West Coast terminals as a whole, under normal circumstances, 3 to 5% of cargo has a dwell time of more than 5 days. Right now, that is 30%, and that's for the whole of the US West Coast. Looking at Los Angeles, Long Beach alone, 40% of the cargo now has a dwell time in excess of 9 days. This is a major problem. The question then, of course, is why? Why are the importers not picking up the cargo? Surely they need it. Well, then you run into a multitude of problems. There is a severe shortage of trucks. There's an even more severe shortage of chassis. There's not enough drivers. If I finally can get all of those, there's a shortage of rail transport. If I can get that as well, the cargo gets to the warehouse. Many warehouses are overflowing. So you end up with the container just being left outside the warehouse, standing on a chassis. Now you're worsening the shortage of chassis. If the warehouse is available, there's a shortage of labor to actually physically offload the containers. All of these are major problems. The Los Angeles Long Beach port have just announced a new fee structure, basically coming into effect as of yesterday. Then it's going to be chargeable from November 15th, where you have 8 days of free time. If you exceed that by 1 day, then on day 1, you pay a $100 fee. On day 2, you pay a $200 fee on top of the 100. On day 3, you pay a $300 fee on top of the 100 plus 200. So this escalates extremely rapidly. The problematic aspect with this is it is hard to see that an increased fee structure will magically conjure up more physical capacity to move the cargo inland. What is potentially more likely to happen is you might see a slowdown in the number of vessels that are being handled in the ports. Because if I slow down the number of vessels being handled, I'm also offloading less cargo into the terminals. That will allow me to clear the backlog of cargo in the terminals. So from a terminal and inland perspective, and from a dwell time perspective, this will look like improvement. However, the side effect will be that if you think a queue of 74 vessels is a lot, that can be a lot more if you slow down the handling of the vessels. So the fee structure is unlikely to solve the problem. It is more likely to transform the problem into a different kind of problem. I talked a lot about Los Angeles Long Beach, but the genuine reality is this is a truly global phenomenon. APMT shared some data. Here I'm showing it at a regional basis. They have it on a port basis as well, where what they did was they looked at 2019 and normalized how much time does a vessel usually spend in port when you compensate for how much cargo does it actually need to handle in the different ports. And if you look at the orange lines, index 100 is how efficient they had their vessels operated in the year 2019. The orange lines are now in 2021. The only regions in the world that are still performing as well as 2019 is Africa and Mediterranean. Everywhere else in the world is much worse off compared to 2019. So whilst it's easy to see all the vessels lined up off the California coastline, make no mistake, this is a genuinely global problem. And when we have shortage of capacity, this leads to another effect. Every vessel in the world that can sail is already out sailing. But when I can then go to the market and get a $20,000 spot rate on the Trans-Pacific, I would be willing to pay a lot to charter a vessel out from some other trade. And that's exactly what happens. So this shortage in capacity has forced charter rates up to also astronomical levels. If you look at vessels that before the pandemic would cost you $8,000 to $10,000, if you go short term on the charter market, some of these have now been going at $250,000 per day because there is a business value in it for whoever charters those vessels. Where do these vessels come from? That's very simple. They come from intra-Asia and they come from the African trades. To a lesser degree, they come from intra-Europe and intra-Caribbean. So what you are now seeing is a reduction in capacity on these local trades. So you see these local trades experience sharply increasing freight rates, not because the markets are strong, but because the vessels are being pulled out from under them. Operators in these regional trades face a fairly stark choice. Many of these operators use charter tonnage, usually on 12-month charter deals. As those charter deals have expired here in 2021, they can choose to either let the vessels go and then they can't service their customers, or they can extend the charter deals, but a charter deal that before the pandemic would be at say $8,000 to $10,000 for a 12-month deal will now be $60,000 to $80,000, but only if you sign up for 3 to 5 years. So this is causing an upward escalation of price that will persist far beyond the effects of the immediate impact of the pandemic that we see right now. Looking a little bit further into the future, we have very low deliveries of new vessels also in 2022. I mean, we had low injection of capacity in 18 and 19 and 20, also here in 21, as well as in 22. We are in a cyclical upturn in the market. We would have been irrespective of the pandemic. With all the capacity the carriers have ordered over the last 6 to 8 months, this upturn is going to end in 2023. We have a significant injection of capacity. That is great if we look to the medium-term future, but this injection is going to do absolutely nothing to alleviate the pressure on the market in 2022. The only thing that genuinely can alleviate this sharp pressure on the market is if we see the US demand boom come to an end. And is there a realistic scenario in which that can happen? The answer to that is to some degree, yes. If we look at the behavior of the US consumer, if you look on the left-hand side of this graph, this simply shows the orange line, how big a share of their money have the Americans been spending on services, and the blue is then how big a share of their money have they been spending on goods. This covers 3 generations. It goes back to 1959, and basically also then covering the entire history of container shipping. And you can, of course, see the very sharp impact the pandemic had in 2020 in consumer behavior. Before we talk about that, let's look at the period from 1959 to 2019. The underlying trend is gradual shift away from goods and onto services. The only sudden minor spike you see is 2008 at the financial crisis. You see a very tiny blip where for a short period, there's an allocation of more money over to services versus goods. That is quickly normalized. What is more important is over these 3 generations, there has not been a single event at all that materially changed consumer behavior overnight. You see no effect from 9/11, no effect from the dot-com bubble. There is no effect from the oil price crisis in the 70s. There is no effect from the permanent closure of the Suez Canal for years in the 1960s. There is no effect of any of the recessions seen in the US over 3 generations. No effect from political scandals or wars or anything else. Nothing. So this begs the question. The major change we suddenly see from the pandemic, is that permanent? If you talk to the main carriers, some of them seem fairly convinced that this is a new higher level of consumption we're going to continue with. I am definitely not convinced. This drastic change in consumer behavior is not because 350 million Americans suddenly decided it would be great to change our behavior. This is a behavioral change that is caused by an external force, and that's the pandemic. As that external force subsides, it is exceedingly likely that behavior will revert back to norm. This means you're going to see a swing back from goods to services again. That's going to cause a negative pressure on demand growth. But here's the key problem. There's not a soul in the world that can accurately predict when this change is going to happen and how quickly it's going to happen. There are no data to suggest anything in terms of when or how quickly this will happen. In theory, it could happen tomorrow and happen quickly. In that case, you will see a free fall in demand on the Trans-Pacific, and we can solve the bottleneck problems quite quickly. Or perhaps more likely, this is a more gradual transition that will take 2-3 years. And then again, there will be a negative impact on demand growth, but it will be almost invisible on a month-by-month basis, and it will not help us alleviate all these problems in the short term. So the baseline is we will see a correction, but it's likely going to take time, and therefore there is no immediate outlook that we're going to fix all the congestion problems short term. That begs the question, is the market fundamentally going to change going forward? Because one of the arguments you can forward is, surely the supply chain was not sufficiently resilient. We need to build a more resilient supply chain. And standing in the middle of the fire right now, that seems like a compelling argument, but here's the problem. Nobody's going to be willing to pay for it in the long term. Think it through. Right now, and for the next 12 to 18 months, rest assured, all the different shippers, they will build in larger buffers in their supply chain. We will see larger inventories. We will see longer lead times. We will see more buffers built into the supply chain, obviously. Let's try to think more than just a few months down the line. Let's try to think, say, 3 years into the future, and the market has now come fully back to normal. Let's say I'm one of those shippers. I'm importing t-shirts, and I now build a more robust supply chain, and that's great. Rest assured, 3 years from now, if I'm still doing that, somebody's going to look at my business and say, look at that old fool. I mean, he's got a very inefficient supply chain. So I'm going to start a competing business importing t-shirts. I'm going to have a much more lean supply chain. It is cheaper. It is more agile. I'm going to compete. So if you look at this over a period of years, no one is going to be willing to pay extra for that level of resilience. It's just not going to happen, which also means anybody that's looking at investing in assets going forward, don't go into this from the perspective that the world is suddenly willing to have an excess inventory of empty containers, or have more ships than we normally have, or have larger terminals than we normally have. No one is going to be willing to pay for that added capacity in the long run. That's not going to happen. One way to then look at this is rather that apart from the pandemic, we are entering a more mature and normal phase for container shipping. Container shipping is the younger teenage brother of the shipping industry. We have much older parts of shipping. You can look at the tanker business. You can look at the bulk business. And if we look at those, here, for example, we have for the oil tanker business for the very large crude carriers. This is the freight rate you have to pay to get a crude carrier per day. You see some extreme price swings. In the other segments of shipping, it is not unusual that you suddenly see prices increase by a factor of 10 for a temporary period of time. We've never seen it in container shipping before. Now is the first time. But ask yourself the question, why is it that the other shipping sectors see this more frequently? Simple. They are more mature. They do not have an extreme amount of overcapacity, which means under normal market conditions, there's enough capacity, and there's also a gap from the capacity being used to the absolute maximum. But if you exceed that maximum, you will have a brief period where prices will go through the roof because you don't have enough capacity. That's why you see these spikes. Container shipping has been characterized by perennial massive overcapacity for decades because the industry was rapidly growing. That era came to an end more than a decade ago. Carriers have now spent a decade absorbing the crazy amount of overcapacity. Going forward, the new normal is we will have plenty of capacity, but the gap between the capacity being used and the absolute maximum capacity available in the system will be lower than what we've been used to, just as we see in more mature other arms of the shipping markets. So having sudden price spikes will not be uncommon going forward. We will likely not see spikes as durable as the ones we've seen in 2021 because the pandemic really is a very unique element. But the entire industry should begin to adopt the mindset where going forward, we should not be surprised at sudden, very sharp price spikes, because that's a measure of a more mature industry where on average there is a better balance between supply and demand. So if we look at what's going to transpire in the near term, we're not going to see a reversal to normality quickly. The absolutely most optimistic assessment we could do there is 6 months to come back to normality. That is if nothing goes wrong, which it likely will. So you are more realistically going to look at sometime in second half of 2022. The transition will be anything but smooth. It's going to be plagued by severe ups and downs. So you're going to see sudden improvements followed by deterioration and improvement and deterioration until we get there. There is an element of demand in the market right now that's entirely unknown. There are no data on it. There is cargo standing in containers at origin because there was no space on the ships. There is cargo standing at the factories not loaded into containers because there were no containers available. There is product that has been postponed in production because the guys who wanted it produced told the factory, please don't make my products because I can't ship them. As capacity begin to become available when we resolve the bottlenecks, all this demand will also be flowing into the system, again, adding to this instability we're going to see over 2022 until the market normalizes. In the very, very short term, end 21, you are likely to see a worsening over the next 6 to 8 weeks. Normally, there's a large amount of cargo pushed through in the month leading up to Chinese New Year, but all shippers right now will be justifiably worried about the state of the supply chain. So to the degree it's possible for them, they will front load the cargo and that will be pushed into the supply chain over the coming weeks, very likely setting the stage for a worsening of the congestion problems and an increase in freight rates. Looking further out beyond 2023, I already mentioned 23, especially second half. That's the peak of the structural upcycle. We're going to begin a down cycle. But there's a couple of things that are more relevant to discuss here. First of all, we're going to begin to see the introduction of carbon taxation. Nobody knows exactly how that will be done. One thing I think is pretty clear is it will not be globally uniform. It is something that will be decided in different countries. Likely EU will be the first ones to do it. How much it's going to cost is unknown. Administratively, it's going to be difficult because it will be different from country to country. But the one thing that seems fairly clear is it doesn't matter how much this is going to cost. It will be passed through to the shippers. And the approach is going to be likely, let's call it fairly cynical from the carrier side, because you can definitely argue that we have just seen over the last year and a half that increasing rates by $10,000 was entirely possible in the market, and the market didn't come to a grinding halt. Let's keep in mind, we are moving more cargo now than at any point in history. So despite the dramatic increases in price, goods are still flowing, they are still being booked. So from a carrier perspective, there will be no doubt that you can pass on whatever the cost of the CO2 taxation is. So shippers should start planning for that. The second thing is the introduction of the EEXI regulation, also known as IMO 2023. From January 1st, there will be requirements on the fuel efficiency of vessels, not just in container vessels, but all vessels. It is completely unknown how precisely this will impact container shipping. The most likely outcome is new, very large container vessels will abide by the regulation already, so there will be no impact, but smaller, older vessels will not. And this could very well lead to a situation during 23 and 24 where the carriers will have no choice but to significantly slow down this segment of the vessels. That will effectively remove capacity from the global market, but more importantly, it will especially impact capacity on regional markets and on feeder trades, which is going to be detrimental for anybody operating off secondary ports or in inter-regional markets. And one of the key things to then keep in mind is there is an increasing battle over logistics going on, and this is going to basically rage for the entirety of this decade. This is one of the more important competitive elements on the business models that's going to change. On the practical side, we'll see more consolidation. We're already seeing it. The latest one was MSC that wants to acquire Brazilian niche carrier Lock-in Logistica. We'll continue to see the major carriers acquire niche carriers where they need to augment their portfolio. We will see more consolidation within logistics as well. But the most important battle is for, let's call it the control of the small and medium-sized cargo owners. And this is where there's a large number of very different stakeholders involved. You have the container carriers going deeper into logistics. Now, of course, Maersk and CMA has been very active on this front for quite a number of years, also before the pandemic. The disruption in the supply chain right now is very likely to cause the carriers, also some of the other ones of them, to go deeper into logistics from the perspective, if I own more logistics assets, I can safeguard the supply chain, at least for some of my key clients, and upsell that. And the carriers now seem on track to make almost $200 billion in profits this year. So it's not a shortage of cash to buy logistics assets that's going to hold them back. We also have container carriers that are going to target some of these cargo owners directly using digital solutions. Then you have the existing freight forwarders that are launching their own digital solutions to safeguard their business portfolio. You have some of the digital providers, the most prominent one being Flexport, that are busy building a physical shipping expertise to compete in this market. You have the likes of Amazon and Alibaba that are entering into logistics services from a completely third angle. You have terminal operators, most notably DP World, that are busy acquiring both regional carriers and logistics assets to try to build up a logistics portfolio that will favor their specific terminals. So you got a battle lined up here for not the entirety of the global market, but especially for the small and medium-sized cargo owners that is going to be raging for basically all of this decade. What you are most likely to see as an outcome is this is a battle that's going to favor large carriers. It's going to favor large freight forwarders. It's going to favor very small carriers and very small forwarders that have very specific and defensible niches. But if you're in the middle, this is going to be extremely difficult. And at the end of the decade, you are very likely to see a huge number of especially small and medium-sized freight forwarders that will have been forced to leave the market. The final element I want to mention that's also critically important in the changing business models going forward is the impact of digitalization or automation or what you want to call it. Nobody should have the illusion that digitalization and automation will give you a competitive advantage. It will not. You need to do digitalization and automation because if you don't, you are not going to be in the market. You're going to be run out of the market. You will not be sufficiently efficient. You will not deliver the engagement interaction method that the customers want. So it's table stakes. You have to do it, otherwise you are out of the game. But if you do it, that's not where your profit is going to come from. Your profit is going to come from service quality. It's going to come from the exceptions. There are the negative exceptions when things go wrong. How good are you in then helping and servicing the customers? And the customers will definitely notice whether you're good at that or not. And there are the positive exceptions when there are customers that really need a customized supply chain for something specific. Do you have the skills and the people to actually do this? So at the end of the day, the digital transformation of the industry actually means your people are going to be even more important than they've been in the past, because they are your only source of competitive differentiation. Automation and digitalization is not. It's just something you need to do. With that, I think it's time to hand it back to Holly for some comments and then also for questions. Thank you very much for listening to me up until this point.
Wonderful. Thank you so much for that, Lars. We had a couple of questions flying in, which is great. So I will get to those shortly. Please do use the chat or the Q&A function if anyone does have any further questions. Just to let you know, obviously Lars can talk about this subject. It's a very in-depth subject that you could talk about for days on end. But I hope he's given you a good snapshot today. He does run courses with us on intelligent container shipping and liner shipping, modeling, strategy, and profitability. So you should have our details on the screen if you want to get in touch at training@informa.com.au, and we can talk you through the different ways that you can get involved with these programs. So questions. The first one we've had come in that I've been sent, Lars, that says, where are we? How to measure demand destruction.
That is a very difficult one to measure. It was kind of what I was alluding to when I said there's a dark number of 3 different types of demand, right? The demand that's already been produced but is standing out there. And then there is basically the products that are not being produced because the buyers don't know how they're even going to move it, or it might not be profitable to move it at all. The honest answer is there are no measurements for it. There is absolutely no way of measuring that at all. You could argue, you could sit down and say, what's the shortfall in demand and take that as a proxy, but here's the next problem. There is no shortfall in demand. I mean, we have record high demand levels from a global perspective. So putting a number to that destruction of demand is virtually impossible.
Yeah, it's a tricky one to quantify that one, definitely. The next one, Lars says, do you think governments will start their own shipping lines to fix the problems? That's a good one.
Some governments are clearly aiming at that. You've seen, for example, Thailand wants to go down that path. You have a number of island nations around the world that seems to contemplate doing the same thing. And they are, of course, doing it because they have the belief that this will help fix the problem. My own honest opinion is, I can certainly see some of them go ahead with it, but it's an illusion to think it's going to fix any problems. Long term, they're probably going to create more problems than they're going to solve.
Yeah, a double-edged sword with that one.
Yes.
The next one says, do you think this is the wrong time to start a logistics business due to all the current problems?
No, I don't see this as a wrong time to start a logistics business. It's more a matter of, you can say, this multi-front battle I was outlined before. Take a look at that and say, well, if I have a logistics business that is actually competitive in that environment, there's no time like now to start. I mean, if you can start a logistics business and have a value proposition helping customers in the middle of the worst storm the supply chain has ever seen, then you have a pretty good platform. But if you look at it from the perspective that, well, now's the wrong time because I can't make money in the current environment, well, then you're also basically saying, I can only run my business if the wind is in my back, and that's not a solid starting point.
Yeah, take the ups with the downs. The next one says, noting that digitalization is the way to go to improve customers' experience and improve profitability. What is your take on the pace of digitalization taking place, and what is inhibiting the pace if it's not quick enough?
There are several aspects to that. First of all, before the pandemic struck, there was this notion that especially container shipping was far, far behind the curve on digitalization. I think what the pandemic has shown was the industry was actually further ahead than it was given credit for. The industry shuts down virtually overnight. Most people have to work online and from home, and yet magically the supply chain didn't actually stop. It became a bit more cumbersome, but We actually showed the industry was pretty far advanced on the digital side to keep the wheels turning. Are there major stopgaps still? Of course, but you're seeing a rapid take up in a number of these solutions precisely because it's now been so abundantly clear why we don't want to have the manual stops. So the pace has accelerated. The baseline the industry was at prior to the pandemic was likely higher than it was given credit for. So this development is going to accelerate very rapidly. And even more so, if you look at it from both the liner perspective and also from the perspective of some of the larger logistics providers, I mean, they are having profits right now beyond their wildest dreams ever, which also means they have virtually unlimited funds to fast track this development.
Wonderful. Thanks, Lars. The next one says, is the USA the best first mover to watch from both data, but also size-wise?
At least from data, the US are a lot better than many other countries in providing data on virtually everything related to container shipping. Secondly, let's also keep in mind that a substantial part of the problem is related to the congestion and the demand boom in the US. If we can see an alleviation of it there, that will also spread globally. It will release capacity. It will help us. So I would rather say the US to some degree is the one to watch right now, because it's also the one that is causing the most problems.
Yeah, definitely. This next one's a good one, Lars. It says some government and central banks are suggesting that the current inflation increases are short-term due to supply chain issues that will reduce in the next 18 months, hence why they are not raising interest rates. Do you think this is realistic?
I think that is typically an extremely unnuanced discussion that shows up on inflation, and it needs critical nuancing. First of all, when you're looking at inflation pressure, one thing that's typically put into one big pot is the supply chain problems, for example, in container shipping, and then the supply chain problem related to microchips, which is impacting the auto industry. But those two things are completely uncorrelated. I mean, you don't ship a container full of microchips. So that's one thing to keep in mind, that supply chain problems don't just mean on the container shipping side. The second thing on the inflation part is there are two mechanisms at play, again, at the same time. You have one mechanism where you do have certain product types that will clearly see price inflation. These are product types that don't have a very high retail value. So a sudden $10,000 increase in freight rates, you basically have no choice but to increase the price of those products being moved. So yeah, there is an inflationary pressure. But then you also have other commodities where the retail value is extremely high. If I'm sending a 40-footer of sports shoes with a retail value of $150, that's $1.5 million in one container. If I have to pay $5,000 more, it doesn't really change anything at all. What you're more likely to see in that case is, I would say, normal business behavior from those companies. If I'm a company importing high-value retail goods right now, of course, I would go out and tell the market two things. I'll tell the market there are supply chain problems. There are going to be empty shelves. So you should hurry up and buy my goods before they sell out. Not because I genuinely believe that's going to be the case, but if consumers will buy my goods faster and not on discount, all the better. And of course, I can also go out and say, by the way, I'm increasing my price because, as you can see, freight rates have quadrupled or quintupled. I don't need to explain to the consumers that for my product specifically, it doesn't really matter all that much. I'll just increase my own profitability. My expectation will be that some of the world's largest retailers will come out of this profitably. So the inflation pressure has to be nuanced. Some of the inflation pressure is not related to container shipping at all, like the microchips. Some of the inflation pressure is genuinely related to the transportation costs for low-value commodities. But some of the inflation pressure is just because you have companies right now that have a golden opportunity to increase their retail prices because the consumers are suddenly not as concerned about price as they are about whether they can buy their Christmas goods or not.
Wonderful. Thanks, Lars. The next one says, I understand there is a California law that prohibits trucks above 3 years old to enter the port. Do you think this is one of the reasons that causes the bottlenecks at the port?
I have no idea. I haven't heard about that rule. It might be there. I'm just not aware of whether that's a rule or not, to be quite honest. Let me put a slightly different comment on that one, because I mean, I've been coming to also a number of the intermodal conferences in the US over the last decade. And every year without fail, one of the major issues that were raised was a growing concern of a lack of trucks and especially a lack of chassis. This was an issue for years before the pandemic. The pandemic has not caused this problem. It was already there. For years, there was an unwillingness to deal with the problem. Now the pandemic has just amplified the problem.
Yes, good point. It's good to have that kind of a side point to one about the trucks. I must admit I didn't realize that they had a law about that, but I will definitely look that up. So thank you to whoever raised that question. You've got us both thinking.
Yeah.
The last one that we have here says, what is your view on the long-term viability of Hong Kong as a major port? Do you believe that the development of ports in China will reduce the relevance of Hong Kong as a major port?
Let me answer this one slightly more indirectly, because it's not just Hong Kong that should be worried. This goes down to when you analyze how efficient liner shipping networks should be set up, and when you also look at the growing vessel sizes. Now, I don't believe vessels are going to be materially larger than the ultra-large container vessels we have now. So vessels are not going to grow material in Asia, Europe, but they are going to grow on all the other trades. When that is combined with how you make a network, what you are exceedingly likely to see as a slow trend, again, over the full scope of this decade out to 2030, is a growing competitive battle amongst especially transshipment hubs, not so much origin destination, but transshipment. And I expect a development where over time, you will see cargo coalesce to fewer but larger hubs, which by nature means that you will see some of the existing hubs grow much larger than what they are today. And you could very well be in a situation where you have large existing hubs that will lose all of their transshipment business within the next decade. It is quite impossible to predict right now who will be the winners and losers of this game. But it's a high stakes game, because if you are a major transshipment hub, you really have no choice. You have to go down the path of investing in enough capacity to handle hopefully all three alliances, but at least two of them to have stability of your business. But you have no guarantee you're going to be the winner of this game. So we are going to end up with some extremely large hubs that will be very successful. And you might also end up with some extremely large hubs that have almost no business to show for it.
Wonderful. Thank you so much, Lars. And thank you so much to everyone on the line as well for joining us and getting involved. We had some brilliant questions come in during that webinar. We will be sending out an email with a recording of this session and some more information on the programs that Lars runs. So please do look out for that. That will come to you in the coming days. As I said, thank you so much to everyone for joining us. But the biggest thanks of today goes to Lars. Thank you so much for your insight, for answering the questions and joining us today.